Howdy, Jacob here. Today we are doing another one-off on Sportsman's Warehouse Holdings in the specialty retail industry. Very small company, 126 million market cap on 123 million enterprise value. From an insider ownership standpoint, we're looking at under 4%. So if it's as small of a company as this, I really like it to be at least double digits because then you have a you feel more comfortable without contacting management to make sure that they're doing the right thing that is best for the investors. Uh, but the company was founded in 1986, headquartered in Utah. Revenue side have grown over double since 2014, but it looks like post COVID they had a very substantial jump in revenue. Looks like before that, you're looking at very little growth. Margin side, gross margin is actually the same, but operating margin is down quite a bit. So we'll have to see if that was an acquisition. Okay, there was an acquisition here in 2020, 2021, so that's very likely the reason for this hefty increase in revenue. But again, you want companies to be making acquisitions that are best for you as the investor and the shareholder. And to me, what I care about is free cash flow. So if you're buying a company, if you're overpaying for a company, I mean, obviously I don't like that, but the thing I care about is free cash flow over nearly all else. And so I want gushing free cash flow. And if that acquisition doesn't do that to me immediately, that's fine. But you have to find ways to where that company that you purchased gushes out free cash flow to make me happy as the shareholder. But that's fine. It looks like revenue's up a bit, but those margins going down is not a plus for me. That's definitely a hindrance. And recently, especially, huge drops in revenue. So there's a chance that we could be getting to they could be pushed down to pre-COVID revenues, which would be big time tough for them because with inflation, cost of goods sold are pretty hefty. And then along with that, you can see that from a cash flow perspective, their capital expenditures have gone up immensely. So this could be them reinvesting back in themselves. So that's fine. I mean, you look at Amazon, their capital expenditures have gone up like absolute wildfire, but they're just trying to grow like I don't know what goes faster than wildfire, but um, anyways, so it's fine to have capital expenditures grow for growth purposes as long as you find a pathway to profitability down the road. And so, if you do more research on this, look to see whether you're comfortable thinking that they're going to get back to profitable levels. Or if not, I could see how trouble would occur if these revenues start declining even more and this cost of goods sold stays as high as it is. But in the balance sheet, I mean, you got no long-term debt, 88 million short-term debt. That 88 million is kind of concerning because that's saying within the next year there's 88 million dollars due and they only have 2 million cash on hand. So they will have to issue debt to fund that project. And it looks like they have. It looks like they just issued the amount to cover that short-term debt. Um, 80 million though, is not super concerning if you were to just look at 2021, their best year. They made 219 million, but on a 5-year average basis, I mean, they haven't made money since that immense free cash flow year of 2021. So definitely something to keep in mind as you review the company. And so let's do my assumptions here. I'd say on the revenue growth side, probably pretty flat. I mean, I think this is going to be a flat business. Maybe over the next 7 years, they drop 15% in aggregate and then come back to where they are today. They're able to manage that growth. And then on the margin side, I don't like that free cash flow is not as consistent as earnings. I absolutely prefer it to be the other way around. But I'll probably do a pretty wide range here, maybe 2 and 4. Maybe let's do 3%, 2%. And on the share change side, I mean, they've been buying back recently, but they don't make any money. So I would think they'd actually have to issue shares for at least the beginning to where they're getting to a place that they can not have to issue debt. Um, so maybe let's say 2% here, 2% a year to be able to fund those immediate recent years to where they're not making any money. Maybe they'll increase shares 3 or 4%. Um, but to me, right now, I don't know. I feel like I'm a little scared about those margins, especially for cash flow margin being negative. If it were the other way around, I'd be less concerned if, free cash flow margin was looking very consistent between 2 and 3 because that's how you fund the business. But if on an earnings perspective, it being that consistent doesn't do anything for me because you can manipulate uh, through accounting principles methods of depreciating and amortizing certain assets through different variabilities at times. So I'm a little hesitant on these margins here. Has the stock fallen enough? I wouldn't quite say that for me it has, but again, everyone's different. And so if you are more comfortable in this business and more confident in these margins and the outlook of the business, then absolutely I could see how it could be a buy because um, it's at levels in stock price that it was pre-COVID, and the business is absolutely better than at that point. So that's my perspective. Hope you enjoyed the video and have a great rest of your day. Thank you.